This conference will now be recorded.
Good evening, ladies and gentlemen. This is ClearSafe Trading Frank. It's approximately 8:37 p.m. on an absolutely gorgeous evening here on the New York City, New Jersey waterfront. It is March 17, 2019. We have crossed the halfway mark now on the month of March, and now the race starts till the end of the month, which happens also to be the end of the first quarter of 2019, which is a very important um, date, given the fact that institutional fund managers and the big money measure their performance in the term of what they're doing for the quarter. As I've said many times, and I'm saying it again, that given my background from the Wall Street days, the fund managers will and the mutual funds, the hedge funds, the institutional pension funds will try to print a decent return, in my opinion, um, for the first quarter of 2019, given that we had a strong performance since January of this year. Saying all that, uh, let's be always be aware of the fact that markets in the by the nature of by their own nature is are volatile, and anything can happen along the way, so we always have to be prepared for that. That's the nature of the beast. First of all, let me make a couple of broad points here. We have the most important developments that are coming up this week that all of us should be fully aware of is the Federal Reserve meeting, which I believe is going to be on Wednesday. Let me just check that out because it's a two-day meeting as always, and it's always at 2 p.m. I'm just trying to pull that up on my other screen, and let's see here. Upcoming U.S. announcements. Hold on. It should be, yes, the FOMC, Federal Open Market Committee meeting announcement is 2 p.m. on Wednesday. I was correct on that. And there's a press conference, which is equally important, where Chairman Jerome Powell answers the Q&A session, and that's at 2:30 p.m. Now, this date is extremely critical because, as you know, the markets are fixated on what the Fed is thinking, whether or not they're going to pause their interest rate hike cycle that they started about a year ago, a little bit more than a year ago, what he's going to say about quantitative tightening and things like that. And it is basically a volatility catalyst. So as traders, and specifically as options traders, we have to very, very cognizant and aware and alert that if the markets are rallying into the Fed meeting, we have to pull down um, our long exposure just in case he sounds a bit hawkish. In other words, he sounds a little bit tough and says that he is not willing to pause the rate hike cycle. And so markets immediately, the algos go to work, and we have an immediate pullback. As you know, on Fed day, it is extremely volatile. So Wednesday is something to mark, and 2 p.m. on Wednesday is when the FOMC rate announcement comes. On the other hand, if we have a pullback into the Fed meeting, then you generally want to be long going into the Fed meeting. If we have Monday and Tuesday as overall down days, then you can pretty much rest assured that if the tactical indicators are showing an oversold short-term condition, that you want to buy into it, and the Fed meeting is going to be a positive catalyst, which generally it is. But if the market overshoots and goes up hard into the Fed meeting, then it's only from a trade management standpoint, it's only smart to reduce your long exposure, not necessarily go too short, but you need to protect your profits. So that's number one. Number two is obviously the ongoing U.S.-China trade negotiations. We are getting snippets of information coming out of there. So far, it's been constructive from what we're hearing. The U.S. and China don't seem to be making any harsh comments towards each other. China's latest news is that they are looking to open up their banking and the financial markets to U.S. companies and global companies, and that is something very important. That's going to be bullish overall for the financial sector, who would love to have a huge presence in China, given the population and the amount of services. And we are the industry leaders, the world leaders when it comes to financial products and services. So JP Morgan's, the Goldman Sachs, the Bank of America's, the Citigroups, these are global institutions, and they should benefit from that. Going into the end of the week, as we approach March 22nd, there's a whole bunch of reports that are coming out. The economic leading indicators. We have Monday and Tuesday. Monday, we have the housing market index. That's an important number. We don't need to see if and that's Monday, that's tomorrow, 10 a.m. That we don't need to see a sharp decrease in housing activity in the U.S., which is, as we know, a major pillar of the U.S. Economic GDP. So the key is that if, as traders, we have to be very, very aware of these particular economic numbers that are coming out, because it's going to whipsaw around. Doesn't matter how good the charts look, doesn't matter how good a setup is, it will whipsaw the markets around. We have factory orders coming out on Tuesday at 10 a.m. That's an equally important number, shows whether or not the U.S. economy has started to bounce back. There have been some weak numbers on the durable goods last week. The markets didn't quite like that, but they seem to have shrugged it off, saying that the slowdown, the government slowdown, might have caused that, but we shall see. As we get into Thursday after the Fed meeting, we have jobless claims. Important, not that crazy important, because overall job numbers have been strong. We have the Philadelphia Fed Business Outlook Survey, not that important. Leading indicators, very important, 10 a.m. Thursday. So those are leading economic indicators, and if those are strong, then the markets are going to react positively. As we get into Friday and trying to wind down the week, again, we have existing home sales. We have the PMI numbers, which is the Purchasing Managers Index. There's the inflation numbers, and we need to see a reasonably strong number, not too strong. And we have two other Fed speakers speaking at after the market closes on Friday. That's at 9:30 p.m. And Charles Evans, another Fed member, I believe he's a voting member, speaking at 9:45 p.m. on Friday. So that's a wrap up on the overall economic picture, economic numbers that are coming out. And of course, most importantly, Wednesday 2 and 2:30 p.m., the Federal Reserve meeting. Extremely critical. Good. So now, given all the broader picture, let's talk about how these things affect our trade management. So one of the things that I was thinking about over the last couple of days, I always think about these things, given the fact that we're all in the same boat when it comes to how we manage our trades and what we do. I've produced some pretty phenomenal trade alerts on multiple stocks, whether it be on earnings like Avago, Alta Networks, Alta Beauty, whether it be Mondo DB, which was just absolutely huge. That was last week too. Name that you guys might not be aware of, but you should look into that. That's simple as MDB. We have had big moves on Nvidia. We have moves on Apple, which has been tremendous, nice and steady. I said the stock was going to head back towards 190, and that's what it's trying to do. We have had Boeing, which has gone through major volatility. It's almost like it hit an air pocket, right? Turbulence, no pun intended. Very sad that the second Boeing 737 crashed in Ethiopia. However, we have been doing extremely well with the Boeing trade because we are playing off tactical charts. And of course, the news in the background is noise. But Boeing is, it's a very volatile stock. I'm bullish on Boeing, that they are a terrific company with great ethics. It's a great American institution, and that they will fix their software issues and whatever hardware issues they need to fix on the 737 MAX, and that the stock will fly a lot more than what it has been as we have been trading it, as we know. We saw on Friday, Boeing suddenly turned around and went berserk higher because there was a report coming out that they'll be fixing the software problems a lot quicker than what the market expects. But now the news is coming out, and let's see how the stock will react. That the U.S. Transportation Department, of all things, is conducting a major investigation of the Federal Aviation FAA. What is it? Federal Aviation Association? No, Federal Aviation Agency, and how they gave approval to Boeing's Boeing's 737. So, like like as Americans, we like to do, we like to attack ourselves a lot, right? It's just that, we're like self-loathers. So here we go. The Transportation Department now is starting an investigation on why the FAA approved the 737 Maxes, um, which are relatively newer planes, and there we go. So Boeing will probably open down tomorrow. Let's see what we do with it. Not a big deal, given the fact that as tactical traders, we are always acting on our charts. So saying all that, let me get straight to my little writing pad here. So one of the things that, let me make this bigger. One of the things that keeps on going through my mind is, what do we do wrong? I do wrong things. No, I mean, maybe I do it a bit less than others, but I do it. So good to be. We're very straightforward here at Clueless Day Trading. As you know, we talk direct. We don't talk fluff, and we don't bullshit. Excuse my French. So I scribbled here. Welcome to Clueless Day Trading live webinars, trade management, minimizing trading mistakes. So think about the biggest trading mistakes that we do. These are the things that I do, and I'm sure you guys can relate to it. So let me erase this and write down here, top trading. And after this, we'll get into some charts. Trading mistakes. After all, we are humans. Doesn't matter how robotic we'd like to be, we're trading with real money, and our emotions are directly tied in with that. As I've told all our new members, and we welcome our new member here, Nazir, is that minimizing our emotional component of our trading setup is what we try to do here. We cannot eliminate it, but we can certainly minimize it, and that's going to produce a stronger P&L on our trades, whether they be option trades or stock trades. So biggest trading mistake, one of the, and again, I'm not prioritizing it, I'm just basically mentioning the ones that come to my mind, is we sell too fast. We have a great setup, we have runaway charts, but we're selling too fast. Now, behind every one of these things that we do is one big is one huge reason, and that is volatility, market volatility that happens on an intraday basis. Suddenly, the market drops 100 points, so we're like, oh my God, we're gonna lose all my profits. Let me get out of the whole thing, and we get out, and then we don't get back in, even though the charts are saying it's just a quick snap pullback. And as you know, I constantly, based on my guesstimation and my forecast, which have been overall very, very accurate, I mentioned the uptrend is intact. So if the uptrend is intact, then why are we reacting to sudden movements in the market? Well, because our emotions are involved, and because volatility increases the nerve center in our brain, which says, get out. Don't hold, get out. And especially if we have any decent profits, we tend to get out of all of it. So one is selling too fast, too quick. Number two, big market gap opens. Let me write this down. Big market gap opens need to be sold. Now, this is a double-edged sword, and I'll cover that on the next point. Need to be sold. So what some traders do is they hold on, and then stock, whether it be an earnings thing. So the stock gaps open, you're up anywhere from 50 to 100, maybe sometimes more than that percent on those calls, and you don't sell. And by the end of the day, the stock is still up, maybe pulls back a little bit, the premium is sucked out, and what you had, let's say, 100% profit. By the end of the day, you are down to maybe 30%. So it's very, very important that if you have a big large market gap open, that you need to sell your profits. Now, you can sell everything, or you can sell a partial profits. Now, if you have one call, you can sell, or one put, whichever way you're trading, or it's a gap open up, then in that case, it's a call. You can slice that up, so you have to sell the whole thing. But let's say if you have two or three, and they're cheap, they were cheap, now they're like up nicely. Let's say $4 call is opening up at 9, happens a lot in a lot of the alerts that I put out, and so you need to basically sell some. What I tend to do wrong, and I'm just sharing my thing, I'm basically an all or none kind of guy. All right, so all or none. So that is not necessarily a very smart strategy. I'm always honest with myself. I'm always trying to improve my own trading strategy. So all or none. Sorry. Basically, I sell everything. I should at least leave 4 calls or 3 calls or 2 calls. I should maybe say sell one. But I just like, wow, look at that, I'm up a lot. So let me just take the whole thing out. That leads to the second thing, which is all tied up, is re-entering. What traders tend to do is once they are out of a position, they don't re-enter. Now, markets are algorithmic. They don't care about re-entries, anything. Something falls, boom. They start to turn it around and move higher. They don't re-enter. So what happens is that they miss out on huge percentage gains because the stock turns around. There are so many players in the market. Hedge funds come in. They're like trading. Hedge funds are basically, a lot of hedge funds are running these algo HFT programs, which are doing nothing but dramatically day trading. That's why you get volatility, both up and down. So you don't re-enter. So very, very important to keep that in mind. You have to re-enter that trade. You always have to have some cash on the side. Which brings me to my next point. Whether it's a small account or a large account, you need to always have liquidity or cash available. Somebody say, well, I'm just at a small trading account. It's only a couple of $1,000. Well, in that case, why don't you just have half of that there and half of it trading? You don't have to buy options, which are $15, $20. Very seldom do I show options in that range. Most of them are between $2 and $5 or $6 or $7. Or sometimes the lottos are a lot cheaper. They're 40 cents, 50 cents. So if somebody comes in with an excuse that they can put cash on the side, going into a new trading day, then that's a complete bullshit excuse. So always have to have cash on the side. The general rule of the thumb is you need to have roughly 40%, and that's just my experience, 40% of your portfolio in cash. So if you have a very small account, let's say a $2,000 account, then you need to have $800 of that in cash. Why? That cash is not stagnant. You're going to put that to work. Because when you get that other opportunity and you don't have a day trading account, you can refresh the cash that you're selling the same day. Then you can deploy that $800 and get to work, and whatever you sold, the profits from the 2,000 whatever, that goes into your cash account, which you can't touch till the next day because it's T+1 for options, right? Whatever you sell today, it's available to you tomorrow on a cash account. For stocks, it's T+3. You have to wait 3 days. So far, you got guys all with me? Yes? No?
Yep.
Okay, sounds good. Because this is the real mechanics of trading, what I'm explaining to you right now. This is the reality of what we deal with every single day. So this is not the big time picture like, oh, wow, this is what the market's going. Look, the markets can go a lot higher. I've been showing the markets exactly, and it's going exactly to where I'm saying it's going. But in the meantime, if you're not managing your trades correctly, then it doesn't matter which way the markets are going. You're not going to make money. You're going to make money, you're not going to take it, and then you're going to end up negative for the day. That's going to screw with your head. Next day, you're going to be doing something, similar, you're going to end up negative, and all of a sudden your confidence goes. So let's move on. So we sell too fast. big market gap opens, you need to be sold, whether it's a partial or full profits. You need to take that money down. And here is something I want to tell you. So you get a big market open, you get 300-400 points higher, or one stock just goes through the roof. Walk away. Walk away. So that brings us to the next point. Do not overtrade. Don't get too excited. When do traders overtrade? Traders overtrade or excessively trade when they are making money. Their confidence level boosts to a level where it's very, very strong. So like, okay, I'm getting in, Just the way, it's just the opposite of not buying anything when we get those massive dips, whether on a short-term basis or an intermediate-term basis. And you don't re-enter. You don't enter in any of the trades because your mind is shot. Like, oh my God, I bought this and the next day it's down again. So the opposite of that, ladies and gentlemen, is overtrading when you're too confident. You get into too many positions with too much money, and that's dangerous. It happens to everybody. Overconfidence is fatal, okay? Because then what happens? Markets get overbought, and the next morning you have too many positions running. The next thing you know, you're down, you've given back everything that you've made, all that hard work. And then you don't want to buy the tactical lows because your mind's shot. So overconfidence is fatal. Despair, on the other hand, despair and what we call, diapers, like you're so scared, you're not even looking at great setups. Your SOA sitting on your what is fatal. You're missing out an opportunity to make back a significant amount above what you were down on. Which brings to the next point. The next point is dollar cost averaging. Now, this is a critical part, dollar cost averaging, because what you're doing is you're buying something at 4, it's down to 1, and options move fast, especially on the indices. We know that 4 to 1, and you don't act. You got to lower your cost basis. Now, this is totally tied in with the fact that you have to have cash available. So very, very important, and it's all rocket science here, that regardless of what you are in, you got to have some portion of your portfolio available in cash every single day. Every day, per day. So you can react. You could be down on 2 or 3 positions you're long, and then you trade during the day, and you could end up with a positive P&L despite what the market's doing. We have showed this repeatedly. Okay? What else? There's so many things. There's so many things that, from a mistake standpoint. Come up with one, Nazir. Just throw out one that, you have encountered that you repeatedly do that, you're trying to fix. A trading mistake.
I think you've covered most of them.
Okay. Tom?
No, I'm good.
Okay. I'm trying to think of one or two which comes to mind. Oh, this is the one that really, bothers me about myself. You gotta follow the discipline of holding. The discipline of holding a position. This is critical, guys. This is critical. In other words, holding a position, not losing patience. And there's a whole bunch of stocks like that. I'm not talking about the Amazons and Teslas and that type of stock. I'm talking a lot of biotech stocks, a lot of other stocks which are in different sectors that I show, of not losing patience as long as the long-term swing charts are intact. There's a whole bunch of biotechs like that. One of them that I'm going to highlight today is Bluebird Bio. Remember, hedge funds are day trading. So you are going to see massive fluctuations like this for no reason other than the fact they want to get you out of the position. They're trading fast and furious. They're taking into account the noise that's coming out in the form of all the different news flow that hits the markets on a daily basis. And they want to make sure you're out of your position. And then the big thing happens. The stock gets taken over. There's an FDA approval. They speak at a conference, positive news, and boom, it goes up. And then you're chasing the tail end of the move. So the discipline of holding, especially when it's a specific swing trade, is extremely critical. Patience. Now, how do you achieve that? From a technical standpoint, you buy longer, you buy time. You buy April, you buy May, you buy June. So you have time in your hand. What does time do for you? Time basically allows you to longer the long dated calls, especially on stocks like this one, which is moving between a range of $45, $44, and $48, like what's it called? Papa John's. At one point, the stock's going to get bought out. So if you lose patience, the stock will get bought out, or there'll be some big announcement coming out of it, as in restructuring, because Starboard Capital, Starboard Capital, who are the big activist investors in Papa John's, these guys are serious players. They don't care about day trading. They got into Papa John's, took a large position in the company because they want to restructure it, either sell off pieces of the company or sell the whole company to somebody else. So long dated calls, buying time. Very critical. If it pulls back a little bit, add a little bit more. Because a lot of these companies which are in the lower end of the scale, from a daily, from daily charts, they're down here. They were up here, they were down here, and they're moving between a range. Don't lose patience. Because when the range breakout happens and the stock takes off, it's too late to get into it. You got to buy the range. I've made this mistake here and there, and I don't like it when I do it. These are swing trades. So buy time. Okay? No, I already wrote that. Buy time. Don't lose patience. Now, what I find to be a deficiency on my part sometimes is I'm too focused, because I'm running the service and I'm providing all these very actionable information on a real-time basis. I'm watching the market too closely. So when you're watching the market too closely, you become micro-focused. What's the downside of that? The downside of micro-focused is you react too much on short-term volatility in the market. Okay, so good to keep an eye on the short-term picture. Best to keep an eye on the daily, the weekly, the monthly, because the intraday, this is a major mistake that all traders make, especially a lot of retail human traders, retail emotional traders especially. Intraday, the markets are like this. Uptrend is very nice on the even the 1 hour gets choppy. On the daily, the weekly is looking good. We're going to look at these charts, like we always do. Monthly is looking fantastic, but you're losing track because of the intraday volatility. What we call monkeys on a hot tin roof, MOHTR. Okay, it's jumping up and down, and you're missing the bigger picture. Which brings me to the last point, and there's I'm sure there are many other things, and if anything comes up, I'll mention it. But I'm just mentioning some of the things that come to my mind as just basic trading mistakes that traders tend to do. And this is nothing we can escape from, is the futures market. Okay, the futures markets are extremely volatile. Futures are down about 5 1/4 right now, and what does it really matter? It really doesn't matter unless futures are down 22 points because something happened terrible overseas in the Globex markets. Live futures, we're watching. No, the futures markets. We need to watch them. We need to, I'm always showing the E-mini charts. Why? Because they are really the backdrop of what's happening in the markets. But these futures markets, and this is true of everybody, all of us, tend to mess with our heads, and we need to be aware of that. We need to minimize that futures market. We need to minimize the fact that the futures market shouldn't determine our overall roadmap on a particular stock. So this is tied in with the volatility, but that's just the way it is. All right. So just covered a couple of points. I'm going to be, as things come, I'll make a note of that and I'll mention it. But first and foremost, you always have to have some cash on the side. You need to be patient, especially in earnings things. Look at Alta. Remember one thing, and I'll mention to you Alta Networks, why it pissed me off a little bit. Stock opened up big, sold a bunch. Stock turned around, started running big time more. Had a little bit left. Could have bought more. These calls, the 310 calls, they were $13. They opened up around, the market makers are real bastards. Keep in mind, especially electronic market makers. First 5-10 minutes, they don't even move the option. It's like 16. I'm like, man, the stock is up big and it's at 16. And these are the 310, 315 calls, which the 315 call was $11. They stuck it at $15. What? Be patient. And then within 20 minutes, they started running it. It went to 30. So my average cost basis on that was out mostly around the low 20s. I could have gotten in again. So remember, the electronic market makers are not your friend. They want you out of it. And they'll play around with the bid and ask on those options at the open. And there's nothing you can do. So don't make the fundamental mistake, especially if it's a strong stock. Short sell a little bit, but get back into it. And if you have more than one option, hold one. Same thing with Adobe. I'm sorry, not Adobe. Adobe is a reversal trade in motion. Same thing with Avago. Options where Avago 272.5 options were 5 3/4. They went to 27. They opened it up at 11.70, $12. And then they ran it to 27 as the stock almost hit $300. So what I'm trying to say is this is not 1 + 1 = 2. So what you all have to do is you need to somehow find a way in your head not to bail out too fast, especially if it's a strong stock with a very strong earnings momentum, charts are looking good, stay in it. Sometimes I've found if I didn't watch the open, I make a lot more money. But if we are in a position and something's gap opening, we're like, we just want to sell like right there, which is a good thing to do because it feels good, but don't forget to re-enter. Okay. So saying all that, let's move on. We get this out of the picture. Let's see what's going on here. Let's look at the bigger picture here. Here's your bigger picture on the S&P 500 E-minis. This is the weekly. Now I've shown multiple charts across the board, and all of you need to look at it. It's right there on the Twitter feed. It takes a couple of seconds to look at it. Read my comments, takes another few seconds. We have a bullish engulfing bar here. This is hugely positive. This is a bullish engulfing bar. This is a bull flag. This was the couple of 100-point drop when we had 5 days in a row down. Not last week, the week before. It stayed within range. I walked you guys through it. I told you the indicators below, all of them trending higher. Histogram expansion on the MACD. Slow stochastic still above 80 with the gaping mouth moving higher. McClellan oscillator still moving up nicely. And 5 days of pullbacks, but all within the bull flag channel. So this is where your discipline comes in. So at this point, look where we are. Upper end of the thing, upper end of the move here is 2850, 2860. I've already said that. So this is an extremely bullish pattern here. Read my comments from my previous thing. So you need to be overall this, unless we have a major breakdown below. This is a 5-week moving average below 2,800. Then you obviously don't want to be left, holding the bag back down to the bull flag bottom, which is again a big buying opportunity as long as this holds, because that's your 50 and your 34-week moving average. Very, very important. You can see these lines, but that's a bull flag. There you go. In my estimation, this bull flag is going to get to the upper end of the channel and most probably break out on the weekly. What's the time frame? By the first part of April, right before taxes. Markets have a tendency to be very manipulative. You want the markets higher till tax day so that people feel, people can sell some to pay their taxes on April 15th. Believe me, it's not that complicated. So they do all kinds of stuff so the market stays higher so you can sell and pay Uncle Sam big fat taxes. So my estimation is that the markets have a short-term peak sometime by the first week of April. And I'm probably going to be dead right. So you need to have a long bias. Pattern completion, we call it the Texas bullhorn pattern. It's clear as day. Now here we could have a couple of 100 points back and forth. Nothing crazy, still within this bull flag. I'm explaining this bigger, longer term picture. It's simply because what we talked about earlier, you lose sight of this, you're going to screw up all your trades. There, a bull flag pattern at 2,900. In my opinion, full completion. Do we make a new high? I don't know yet, but I think going into the upper 2,800s, couple of 100 points from here, higher, quite a few 100 points from here is very doable. So maybe one of the things that I might suggest tomorrow is we buy April 15th, whatever, or April 18th is basically the monthly options expiration. April 18th, 2,900 calls. Sure, they're not that expensive on the SPYs or the SPX. And just leave it in there. Because this pattern completion has a very high probability of happening, and most probably will happen on the US-China trade deal. And that's when you get this type of pullback. Back there again, could be as big as 1,000 points, whatever. And as long as we hold this 2,700 level, we're good to bounce again. That's how markets work. All right. Distractions, micro distractions during a trading day. I have no idea what distractions. I don't have any distractions. My only distraction is volatility. So I don't know what Mike means by saying distractions. Whatever other distractions you have, like feeding the chickens, peeling a potato, or I don't know. So I don't know what to say with that. Yeah, you need to be very focused. You don't need to be a robot. I'm very focused when I'm working, but I tend to get off my desk and walk around there a bit, go say hi to my dogs. But I don't know what other type of distraction, so whatever personal distractions anyone might have, we'll fix it. All right. So anyway, Mike. So that's your longer term picture. Let's take a look at the and not that long term. Let's take a look at the daily. Same story. Same story. Now, traders who are not short traders, they keep on missing out every single move in the market. They are so shit scared. Excuse my French again. That's a New York term for saying very scared. Okay. They're so freaking scared all the time. They're never taking any real trades. And look at this. And this is most probably what's going to happen. Yes, we have the Berlin Wall here. We broke above that. I call it the Berlin Wall, which I explained in my previous video. Right there, this line. This line actually should be adjusted here. I don't know why it was adjusted lower. There you go. So we actually haven't even, we slightly broke above that on Friday, right there. And this is where we are right now. And as traders, you have to be aware of the fact that each one of these moving averages are your support levels. Your first level of support comes in at the 5-day moving average, which has been very effective, as all of you know. For me, some people use the 8-day moving average, some people use the 9-day moving average. It's up to them. I use the 5-day because there are 5 trading days in a week. The 5-day moving average is 28.17. We are currently at 28.25. So futures could be honestly lower, and this is where your technical discipline has to come into play, where your head doesn't need to get messed up. Futures could drop 8 points from here, which means we would be down 13 S&P points. What's the first thing that goes through an average trader's head? Oh my God, we're down 13 S&P points. Lord help us. Nothing. It's just simply retesting the 5-day moving average. If it breaks below that, you can be a tactical trader, trade the market down to the 20-day moving average. That's roughly around 27.91. That's a 25-point drop. That means the market would drop roughly 150 Dow points. Again, another buying opportunity. This is also happens to be a, let me change the color. This happens to be an inverse head and shoulder, and my other charts have clearly shown that right there. So is it not possible that the markets do this? This is the big head and the inverse head and shoulder, the big daddy, where we have multiple shoulders here. 2650. Do I think we go to 2650? We can. We can. Does it happen immediately? I don't think so. So each of these support levels are, there's your head, there's your left shoulder, right shoulder. So even if we drop 150 points, there could be a Boeing news. It could be, Apple's pushing the markets higher. These are the ones, the pillars that move up the Dow Jones Industrial Average, too. So next thing you know, you need to freak out. You can short the market, but don't go to bed thinking, oh, that's it, it's the end of the market. No, you can short the SPYs, but try to close your positions by the end of the day. And if you do carry it overnight, have a little bit of it. Now, this is also, we watch the VIX big time, as you know. If the VIX is on a big move up, like we had last week, not last week, the week before, then you need to watch those levels on the VIX that I have pinpointed to the highest degree of accuracy, and see whether or not you want to carry that short SPY position in the form of SPY puts or whatever other short that you want to do, but you don't want to be getting too comfortable. So far, the market's uptrend is intact. The next level of support comes in 20-day moving average, then 34-day moving average, 50-day moving average. So you got to follow the charts. The internals are all good to go. Still strong. McClellan oscillator is still strong. MACD, is strong. McClellan oscillator is not even overbought. It's down here. In order to get overbought, it's got to be over 100. Now, some people might say this is a negative divergence, where the McClellan oscillator is making lower lows and the market is making higher highs. I say that I'm being on a short-term bullish bet. I believe that this has a chance to go higher, breaks out over towards 100. That means we basically push higher towards the upper end of the range and possibly break out a little bit more. Now, this line here is where we are shooting for on a daily basis, not on a weekly, on a daily basis. We can say that that's a major resistance. This is a major resistance. We need to stay above that. We broke out over that on Friday, despite the fact that Boeing was down, even though it turned around hard. Was it down or up? I forgot, because we were making money. Boeing was up because Boeing was up about some dollars. From the bottom, it was up a lot. We caught the bottom, 366, went to 385. Within what, an hour? Follow my charts. It's all there. Go take a look at it. Boeing now is a very tradable stock. If you're shorting it, be quick on the trigger because it's very oversold. It's a major staple. Big time smart money knows that Boeing's going to fix their problems. So the stock can go, so they'll buy those tactical dips in a big way. So here's your Berlin Wall. So we broke out over it. We might pull back a little bit, but the real Great Wall of China, if you want to put it that way, is 2,900. All right, that's the real one. So somewhere in the high 2,800s, 2,900, because that's where the big fallout started, right there. So we could be trading in a range of a wide range for the next couple of weeks of 2,755 and 2,900, but that's quite a few. That's 2,755 is roughly 25. 60. That's that's like a 300-point drop, and then 300 points on the upside, 300 to 400 points on the upside. So that's it. So far so good. There's nothing's changing. Let's take a look at some shorter term charts. I'm going to show two. So here is an absolutely beautiful trading chart. There's no question about it. This is a 15-minute chart. You can see the bull flag channel right there. We have two. We have one here. Let me change the color. We have one here, which I said was going to break out, and it did. Came back and retested it again, broke out. And then we have the broad macro one right there. The dotted line. Let me do this right. So it's your dotted line here, and there's the other one. So it's not rocket science. There's a lot of traders we have who just trade the SPYs. So they live and breathe these charts. The red lines are support. This is the real support, 2785. This is the intermediate supports. We are within the large macro acceleration channel, which tops out around 2860. if you're trying to micromanage your trades too much and you're trying to trade every 15-minute candle, you're going to just perish. If you keep an eye on this and set up your positions accordingly, then you're going to win. So we could fall within this channel again and get back to 2800. No question about it. We are still bull flags. This is a bull flag. This is a bull flag. This one, this one. There's one, here's one. So you got to keep an eye on these things. And the more you trade off this stuff and not worry about every 15 minutes what's going on, you're good to go. You're good to go. This is some of my charts I like a lot. This one I like a lot because this gives me an exact GPS of what can happen this week and the following week. Let's take a look at the next one. Next one is a 1-hour chart with Fibonacci retracements. What more can I say? I said we would get back to the 50 Fibonacci level. We did. And this is simply since last week. Last week and the week prior. So while the rest of the world were panicking and many of you were just like, I don't know what you were doing, we nailed the bottom. We said we were going to get back to the 50 Fib because on any waterfall decline, you tend to bounce back to the 50 Fibonacci retracement. I even write that down in plain English. We did. We broke out of it. We hit the other Fibonacci levels. You don't need to even calculate it. I'm showing it to you guys here. I even put dotted lines so people can focus on these things. And then now we're in this bull flag. Now, is it possible that we come back and retest a breakout over the Fibonacci retracements, the one being the 100% level? Sure. The 100% level is right now at 28.19. So we could very well do that. We could very well come and retest this breakout. Here. I just explained to you that on the 15-minute charts at 2800. What we wouldn't like to see is a break below the 2800 psychological level. But you can see here, every candle is 1 hour. So you don't need to be jumpy. You don't need to be a monkey on a hot tin roof. You don't need to freak out every single time. Stay focused. Now, one other thing about Fibonacci retracement, this is called a Fibonacci extension. 1.61, or you can turn it into percentages by simply multiplying 100. It's 161.8. Okay, 161.8% Fibonacci retracement. This generally happens on an outsized move on the market. An outsized move on the market would be some sort of a reasonably positive framework of a US-China deal. The markets are literally going to go like this. A Fibonacci retracement extension happens on a major catalyst. I have shown that on some charts, and it's happened. So you have to be prepared for it. If you are thinking that the market's going to allow you to get in at the time it's happening, then you're doing the same old stupid stuff you've been doing forever. You have to have the setups prior to it happening. So we look at indicators. I analyze the information coming out of the broader markets, news announcements, and then I put in my forecast. Use your own gut feeling. If you think we're in a hell in a handbasket as the market is climbing towards 2,900, well, that's your problem. That means honestly speaking, I don't know what that means. That simply means you're either a complete chicken or you just do not have the guts to be a trader, which most people don't, to be honest with you. Or you just don't believe in the United States of America. I'm dead serious. You don't believe that we can overcome a lot of the difficulties that we are faced with. You don't believe that there will be any US-China deal. You're just basically a dogmatic bear. You don't believe in US companies excelling, which we certainly have some of the finest companies in the world. You're just basically a dogmatic bear. So you're not going anywhere. I'm not here to change your mind. So saying all that, is so far so good. The 1 hour charts are looking good. I'm going to be watching these very carefully. Futures are down about 4.25 right now. We'll probably get some turbulence tomorrow morning on Boeing, given the fact that the transportation department is investigating the FAA. That's unheard of, about why they approved the 737 MAX. Yeah, this just boggles my mind. We like to attack each other. It's like it's a internal parasite trying to eat your own body. So Boeing will be volatile. I am overall biased long Boeing, and I believe that is a monstrous trade in the making. I've already showed that. Boeing calls jumped from 5 and change that I asked you guys to buy on my tactical lows. Look at that Boeing chart with the with the concentric circles, half circles, Fibonacci circles, I believe that they were, and they were exactly what they went. So the calls jumped from 5.25 or $5.35 at the low to $16 by one call. Boeing is a very hot trade right now. It is going to be volatile. It is a money maker. You gotta trade my charts on Boeing. You cannot get too negative on Boeing. And if the stock does break down certain levels, and I'll be again updating the charts first thing in the morning on Boeing, then that's a different story. You can short it quickly, but don't go to bed shorting Boeing. I'm telling you right now, do not be idiots on that. Now, the stock could completely collapse. I doubt it, because so much bad news has been put in there. But that's the way it is. So let me show you all a picture of a nice swing chart. This is probably the perfect technical setup I've seen. But Mr. or Mrs. Volatility, whoever they are, gender neutral volatility, is a biatch. Okay, so hopefully they don't mess up with this chart. And that is Bluebird Bio, one of the leading amazing American companies on the front of revolutionary breakouts on CAR T cancer therapy. Anyone who has lost anyone on cancer, I did, my mother, many years ago, other family members here and there, know how critical these companies are. So anyway, so look at this chart here. This is the stock, I believe, was higher than 200. We're looking at the daily chart. So let's focus on this. So here is your first level. That's your major neckline. Here is another neckline. Here's your head. Here's your left shoulder. Here's your right shoulder, slightly higher than the left shoulder. This is also a cup and a handle. And now we're hitting that 160 level. This level is at roughly 160. It is 160, not roughly. The neckline's at 175 to 180. There's a gap fill here. That's the first level of pattern completion. What does that mean in simple English? The stock can move up. The stock was up almost $8, right? Something like that on Friday. It's a good looking technical chart. Now, it is trading within a range. This handle could trade within a range because hedge funds love trading this stock somewhere between 151 and 158. So don't freak out if it's down 6, as long as this range holds. Or, as long as it's between 150 and 158, it's going to build up internal momentum to bust a move towards 180. That's the reason I've been saying buy the April 180s. Go out to May if you want, but why pay up so much? As you get closer to April 18 monthly options expiration, then maybe push it out. But something is about to happen, and this is not magic. All right, this has nothing to do with China, but this is a good looking technical chart. The internals are cooperating. The full final pattern completion is around 200. In between, there's 180. Left shoulder, right, left shoulder, We are in the right shoulder zone right now. If fast move towards 170, 180, you could buy the 160s. I mean, I did mention, I think 170 and 180. I can't remember. I know the 180s. The calls are not that expensive. The 180s for April are $2 and change. $2 and change, guys. Don't need to focus on everything. Sometimes focus on a few stocks, and this is a great technical setup. And I like it a lot. From it, you know, if I was teaching a college course on technical analysis, which by the way, no colleges have courses on technical analysis as far as I know. Okay, how idiotic is that? That this is as classically brilliant as you can get, textbook perfect. But saying all that, you know, Mr. Volatility is going to move the stock up and down, and hope none of you get too freaked out. This is nice. Sorry, let me change this. This is nice. There was a double bottom move here. This is nice. This is nice. And this is certainly quite nice. Okay? As traders, we only want things to go higher if we're long. Hey, I'm with you on that. So we'd like to see it bust a move over 160 and hit 170, 180 real fast. At which point, you have to take profits because that is the first level of this pattern completion. Make some very decent money. And God help us if the stock gets bought out. So let's take a look at the weekly. Where can this baby go if the stock gets bought out? Now this is a weekly chart, and this is a sexy chart. All right. Look at the weekly chart. We got one down week. We got a bullish confirmation here last week. It's about to go. Now, saying all that, probably open down $2 or $3 tomorrow just because of the market, for all you know. But it doesn't matter. This is what you do the swing disciplines for. I have had traders who just buy the swing, a few of the amazing swing trades like this, and say, I don't want to trade during the day. I just want to sit on these things. And they have made crap loads of money over the years. And they don't have to wait around for a year. These things happen on a multi-week basis. This is a good-looking chart on the daily. That's your buffer. That's where the stock wants to go. Now, the high for the stock was 236. If it is a buyout, they're going to pay a premium of anywhere from 50 to 70%. Now, how do I know that number? Look at the previous buyouts on other companies. The big boys, the Gileads, the Celgenes, the Pfizers, the Mercks. These companies are not growing unless they buy these revolutionary companies, these mid-cap, small-cap companies, and add them to a portfolio. So if you get it's a $158 stock and it gets a 60% premium on the buyout, you're at 252. So you're somewhere in this range here. Let's take a look at Apple. Another real easy trade that I showed, and all you gotta do is just hold it. How much are Apple calls? They're $1.50, $2. Then they go to 5 and 6. You don't even have to look around. That's one heck of a good looking chart. Now it is attacking. I was showing Apple here. I was showing Apple here. You don't have to look around. You don't have to scratch your head and say, what should I get into? Buy these Apple calls, just leave it there. Sometimes I get pissed off because I have a bunch of Apple calls and I sell them within, it's up a lot. So I'm like selling them and they're like, why did I sell it? But then I get back in and buy the other ones. That's my doggy saying it's time for you to stop moving. Needs a walk. So one of our doggies. So the 50-day moving average is right here. The stock's attacking it right now. The 34-day moving average is 191. And then, so again, Apple moves in increments of $3 or $4. That's a bullish candle week. It's a very positive thing. Most Apple can get to if things go really over the short term is 195. And God help us if Apple enters this acceleration zone that it broke below back in on November 19th, it can back test that. That's 204. 204. Can Apple get to 204? Absolutely. Can Apple enter the zone? I think it's going to get a lot of resistance. Enter this channel here. But can it get to 200 to 204? I think it can, given the bullish nature of bullish formation of these candles. Let's look at the internals. Nice, very nice, and very nice. Okay, the MACD histograms have started to accelerate. They started to accelerate from the time that Apple was 176, 174, telling people buy it, buy it. Sometimes I wonder why don't just put like everything in Apple and just sit there, especially when we catch the wave. Believe me, it's a very smart idea. Very good. And this is very powerful. You have a crossover, and that crossover on the MACD histograms happened at 171. You don't need some idiotic analyst or some guy, some great trader on StockTwits or other forums that you follow, or some talking head on CNBC or other financial news outlets telling you. You just follow these indicators. That's it. So I want to wrap up. I will certainly answer any quick questions that you guys might have. So go ahead and shoot one or two if you'd like, because I need to wrap up. Anyone? Tom? And the other stock, which, like I say, doesn't take much, which I am extremely excited about, not just because the trade's working, but because of the chart formations. These are almost like those trades which are just given, and you know you could make money on it, and you still don't do it. It's terrible. That's an unforgivable sin. Nvidia. I know it's going to hit at around 174. It's going to try to enter this large gap. This is actually a gap on the daily. It's the weekly chart that I'm showing you. Look at this candle. 149 to 169. That's 20 bucks. You know what happened to Broadcom, right? Avago. This is Avago Junior. And it's way off the highs when everybody was super excited about Nvidia. That was almost $300. Why can't the stock, on a short-term basis, stock can go to 175? This is one of those trades that I sometimes really slap myself because I have a bunch of it, and then I'm like, middle of the day, it starts dropping. I'm like, okay, let me get out of it. This correlates with exactly what we talk about, trading mistakes. Just don't do that. Hold a bunch. Yeah, if it's up a lot, sell a little bit. Move the strikes forward. It's going to kiss this mark here, 174. And then if it enters this gap, the stock is going to $200. And even then, it's going to be way off the highs. But do you see what's going on here? Now, in between, there could be an analyst downgrade. It could be something, a bad day in the market, blah, blah, blah. But this is another stock, which is a complete swing trade discipline. You got to follow it. Okay? So, looks like there's no questions. Thank you for your attendance. Other members will appreciate the fact that you guys were here. I conducted this strategic webinar, explained a whole bunch of very powerful information. There's a whole bunch of other charts and stuff that I wanted to show, but I figured, you know what, forget it. Now, I need to wrap up. I'll probably do a quick session, maybe, Wednesday is our next webinar, so wait till then. I explained a whole bunch of things. These are extremely actionable information that I gave you, both on the macro fundamental as well as the technical basis and the behavioral stuff, which is our trading mistakes. traders trading mistakes and such. And I think this was a terrific session. Thank you again. Most importantly, please provide some solid referrals, the least you guys can do, and follow us on Instagram, the least that anyone can do. Or follow accounts going higher. More importantly, for your own benefit, I have great option charts in there that I post at the end of the day. Stuff that we do. Feel free to take a look at it. That's how you train your mind. Next time you see an options thing, I can't show real-time option charts too often because it just takes too much work. But I tend to show the highlights of some of the big options movers in the form of options charts on our Instagram at the end of the day around 9-10 p.m. Eastern Standard Time. So follow it, take a look at it. Certainly will benefit you. On that note, God bless you all. Thank you for being here. Thank you for all the support everyone gives Crusade Trading. Let's grow. Let's grow our community. We're young, and we are delivering some serious performance. I'd like everyone to be involved in it. If anyone needs any specific help, then highly suggest, like I always say, direct message, DM me for info. Join the advanced ACS coaching sessions, and anything else within reason that I can do, I'll do that. Have a great evening. God bless you all.